Uh, $7 trillion. That's, I mean, that is the number that just immediately jumps out from our sources today. We are looking at a daily trading volume that absolutely dwarfs the New York Stock Exchange.
Yeah, it really puts things into perspective, doesn't it?
Hmm.
We aren't talking about stocks or crypto in this deep dive. We're focusing on the foreign exchange market, or Forex. It's the largest, most liquid financial ecosystem on Earth.
And unlike the NYSE, it doesn't have a physical address. It's entirely decentralized, just a global network where money itself is the actual commodity. So, based on the research, our mission for this deep dive is to unpack the mechanics of this beast, specifically that brain-bending concept that you are always buying and selling simultaneously.
Right. That is the core of it. I mean, if you've ever swapped dollars for euros at an airport, you've technically dabbled in it.
Hmm.
But to actually trade it, you have to wrap your head around the currency pair.
Because in this market, value is always relative. You can't just buy a euro in a vacuum. You trade the URUSD pair.
Exactly. Think of it like a tug of war. You have the base currency, which is the first one listed, and then the quote currency. The price on your screen is literally just a ratio showing how much of the quote currency it takes to buy one single unit of the base.
So if I'm buying the pair, I'm essentially betting on the base currency to rip the rope away from the quote currency. And looking at the charts in our materials, this gets really fascinating when you throw gold into the mix.
It really does. The sources highlight that in Forex, gold isn't just some shiny metal. It's treated effectively as a currency, ticker symbol XAU. And you almost always see it paired against the US dollar.
It's the ultimate safe haven play, right? The research points to this historical inverse relationship
Where
where,
traders get nervous about fiat currency.
yeah, exactly. Whether it's inflation, geopolitical messes, or the Fed printing money, they dump the dollar and buy XAU.
It's a hedge against the printing press. If the dollar is the confident bet on the American economy, gold is the fear gauge. When the dollar weakens, gold tends to shine.
Now, knowing what to trade is one thing, but the sources spend a lot of time on the how, specifically the tools that make this market so dangerous. And the big one is leverage.
Oh yeah, this is where new traders usually get carried out on a stretcher. Leverage is using borrowed capital from your broker to control a massive position with just a tiny amount of your own money, which is called margin.
It acts like a magnifying glass.
For both sides, it definitely boosts your potential gains, sure, but it equally magnifies your losses.
Yeah.
You're sweating over pips, those tiny fourth decimal point movements. But with high leverage, a small move against you can wipe out your whole account.
Right, and while you're worrying about the pips, you're also paying the spread. That's the gap between the buy and sell price, basically the broker's cut. So how do traders actually decide which way the market is going? The sources divide them into two distinct tribes.
It's almost philosophical. You have the fundamentalists who are glued to the news. Interest rate decisions, GDP, employment reports. They track the economic health of nations.
Versus the technical traders who probably don't care at all who the president is. They're looking at lines on a chart, moving averages, RSI indicators. They're hunting for patterns in human psychology.
But here is the critical takeaway from all our reading. It doesn't matter which analysis you use if you don't survive. The most successful traders aren't obsessed with making money. They are obsessed with risk management.
The old saying, defense wins championships.
It absolutely has to here. The two tactical pillars the sources emphasize are stop-loss orders and position sizing. A stop-loss is your preset ejection seat. You decide before you enter a trade, if the price hits this level, I'm wrong and I'm out.
No hoping, no praying, just out.
And position sizing is the discipline. The golden rule across the board is never risking more than 1 to 2% of your total account on a single trade. If you bet the farm, the market will eventually take the farm.
It's a survival game played on a 24-hour clock. That was the other thing that stood out to me. This market never sleeps.
It just follows the sun. 24/5, starts in Sydney, moves to Tokyo, then the massive London session, which is usually the most volatile, and finally New York. It's a relentless shifting machine.
Which brings us to a final thought for you to chew on. We walk around every day thinking the money in our wallet is a fixed standard of value. A dollar is a dollar.
But in this deep dive, we see that's an illusion. Your local currency is just another commodity, fluctuating wildly every second, just like oil or gold.
It really makes you ask, what is that money in your pocket actually worth right now?